Hello, friends. Since 1947, the Indian rupee's journey reflects India's economic resilience, evolving policies, and the impact of international events. India's economic shift from an underdeveloped agricultural economy to a leading, rapidly expanding global economy is mirrored in the rupee's performance against the US dollar. Let us explore the rupee's historical phases, focusing on the government policies, RBI actions, and global factors influencing its value. When India gained independence in 1947, its exchange rate was pegged to the British pound sterling under the Bretton Woods system of 1944. The starting exchange rate was 1 US dollar to 3 rupees 30 paisa, showcasing the rupee's stability within the colonial economy. This stability, however, did not last long. Because of Britain's post war economic problems, the pound sterling was devalued in 1949. India, being heavily reliant on the British economy, quickly adopted the same policy. The Indian rupee underwent a devaluation, resulting in a rate of 4 rupees 76 paisa per dollar. To stay competitive in the export market, India devalued its currency, a move that highlighted its global economic vulnerability. India in the 1950s and 60s implemented import substitution industrialization to decrease foreign reliance and create an independent economy. This strategy, while boosting domestic industries, also caused trade imbalances and reduced foreign exchange reserves. While the rupee stayed linked to the pound sterling, the economy was burdened by growing fiscal deficits and slow growth. India experienced a serious balance of payments crisis around the mid 1960s. Droughts, foreign aid dependency, and wars against China in 1962 and Pakistan in 1965 placed an enormous burden on the economy. Facing pressure from the International Monetary Fund or IMF and the World Bank, India devalued its rupee by 36.5% in 1966, fixing the exchange rate at 7 rupees 50 paisa per dollar. This controversial devaluation was necessary to tackle the trade deficit and attract foreign aid. It indicated a change in India's economic policy, prioritizing structural reforms and deeper engagement with the global economy. However, the initial period was tough because of devaluation, which caused inflation and public unrest. Global finance entered a new era when the Bretton Woods system collapsed in 1971. Following the global move to floating exchange rates, India implemented a managed float for the rupee. For this, it relied on RBI intervention for stability. The Indian rupee's value was linked to a group of currencies, mainly the US dollar, British pound, and Japanese yen, starting in 1973. The 1970s saw global oil shocks as well. India's heavy reliance on oil imports led to a sharp increase in its import bill following the 1973 embargo by the Organization of the Petroleum Exporting Countries or OPEC in 1973 and the oil price surge in 1979. These shocks caused inflation and a weaker rupee, reaching an exchange rate of 8 rupees 39 paisa per dollar. India's managed float system, despite the challenges, provided some stability, enabling the Reserve Bank of India to mitigate excessive price swings. That decade, however, showed how vulnerable the rupee was to external pressures, thus emphasizing the need for a more diversified economy. The year 1991 marked a turning point for India's economy. It faced a critical balance of payments crisis worsened by the Gulf War and higher oil costs. Only 3 weeks' worth of import funds were left. To prevent a default, the government used its gold reserves to secure IMF loans. India started wide ranging economic reforms under Prime Minister P.V. Narasimha Rao and Finance Minister Dr. Manmohan Singh. The rupee was devalued in two stages. First to 21 rupees 20 paisa per dollar in July 1991 and then again to 25 rupees 80 paisa. The year 1993 saw India shift to a market driven exchange rate, ending its fixed rate regime. Deregulation, privatization, and foreign investment, which were the hallmarks of liberalization reforms, sparked a new era of economic growth. India's economic globalization caused the rupee to become more susceptible to market fluctuations. The IT services boom, outsourcing, and FDI spurred rapid economic growth in India during the 1990s and 2000s. Throughout this time, $1 traded for approximately 50 to 40 to 50 rupees, with variations stemming from international and national economic factors. India's robust economy and investor confidence led to the rupee appreciating to 39 by 2007. But the global financial crisis of 2008 created fresh challenges. The rupee crashed to 51 by March 2009 because of capital flight. The Reserve Bank of India stabilized the currency by selling dollars and attracting foreign capital. Again, in 2013, the US Federal Reserve's announcement to reduce quantitative easing, known as the taper tantrum, caused a capital flight from emerging markets. A record low for the Indian rupee was set in August 2013 when $1 was worth 68 rupees and 80 paisa. To counter the situation, the RBI and the government introduced a range of measures, including raising interest rates, establishing swap windows for foreign currency deposits, and limiting gold imports. While these actions stabilized the situation, the event highlighted the rupee's vulnerability to global finance. Rising oil prices, global trade tensions, and the COVID 19 pandemic pressured the rupee over the years. A consequence of the 2020 pandemic's economic instability was a drop in the rupee's value to 76. The 2022 Russo-Ukrainian war worsened the situation, causing the rupee to fluctuate between 80 and 83 in 2023. Despite some difficulties, the Indian rupee enjoyed relative stability in 2023. Against the US dollar, it dropped only 0.8% from 82 rupees 66 paisa to 83 rupees 35 paisa. This was actually an improvement from 2022's performance, which had been the rupee's weakest since 2013. Although global tensions and a robust dollar pressured the currency, inflows of foreign investment and India's sound economic base bolstered it. But the situation dramatically altered in January 2025. The Indian rupee hit a new record low of 86 rupees 62 paisa. This is a significant decrease of 4.2% compared to its value at the close of 2023. A further decline to 90 or below is expected in the coming days. A few factors have caused this decline. A stronger US dollar and higher US bond yields globally have reduced the rupee's appeal to investors. India's economy is struggling with a widening trade deficit, slower growth, and the inflation exceeding US rates. Foreign investors withdrawing from Indian markets has further weakened the rupee. The resilience of rupee in 2023 to global pressures contrasts with 2025's more serious domestic and international issues, causing a steeper decline. Many domestic and global factors influence the rupee's value. The range of factors spans government and central bank actions as well as global and domestic economic trends. Policymakers, investors, and businesses must understand these elements to manage the currency's volatility and its economic effects. Government policies have historically played a key role in shaping the rupee's trajectory. For example, the 1991 economic liberalization was a turning point which opened India's economy to foreign investment and trade. This action stabilized the rupee, thus leading to further economic growth. Reforming India's indirect tax system improved investor confidence and helped the Indian rupee to attract foreign direct investment or FDI and foreign institutional investment or FII. The government needs to implement further measures. India's $49.3 billion FDI during 2022-23 highlighted its successful policies. Active intervention in the foreign exchange market by the Reserve Bank of India is crucial for managing the rupee's value. The central bank employs dollar sales and interest rate adjustments to control excessive market volatility. For instance, the RBI used dollar reserves to stabilize the rupee in 2022 when it had declined sharply. Liquidity management and inflation targeting by the RBI directly impact the Indian rupee's value. International factors affect the rupee's value. India's position as the world's third largest oil importer makes oil prices a key factor. India's import bill and rupee were impacted in 2023 by the crude oil's price volatility ranging from $70 to $95 per barrel. Once again, the US Federal Reserve's 2022-23 rate hikes caused a capital flight from emerging markets like India. All this weakened the rupee. The rupee's resilience has been challenged by global financial crises, including the 2008 meltdown and the 2020 COVID 19 pandemic. The global flight to safety during the pandemic caused the Indian rupee to reach an unprecedented low of 76 rupees and 91 against the US dollar in April 2020. India's strong foreign exchange reserves and quick policy actions, however, steadied the currency, but not for long. Domestic economic indicators like inflation, GDP growth, and current account deficits have a direct effect on the rupee's worth. Continued inflation can reduce what the rupee can buy. The current account deficit remains a concern. A higher current account deficit increases the demand for foreign currency, putting pressure on the rupee. So, to conclude, the rupee's value is shaped by a dynamic mix of government policies, RBI interventions, global economic trends, and domestic economic conditions. While challenges like trade deficits and global volatility persist, India's robust policy framework and resilient economy provide a strong foundation for the rupee's stability. With further reforms and prudent management, the rupee will be able to navigate future uncertainties. The rupee's trajectory mirrors India's economic development. Its history from the post independence fixed exchange rate to today's market driven system shows how domestic policies, RBI actions, and global economics interact. The future trajectory of the rupee will depend on India's ability to sustain economic growth, manage external vulnerabilities, and adapt to an increasingly complex global financial landscape.